Good day, everyone. Today, I'll be continuing my discussion about the financial statement, but before that, I will be giving you a recap to the topic we started in the last meeting. So, what is financial statement? So, financial statement are like a set of reports that give a clear picture of a company's financial health and performance. Think of them as a business report card or showing how well it's doing with its money. There are typically three main financial statements. It's a lot, but we focus on three. The first one is the income statement or the profit and loss statement. This statement shows a company's financial performance over a specific period, like a month, quarter, or even year. So it outlines the revenue earned and the expenses incurred to arrive at the net income or net loss. It helps to understand if the business is making money. So let's continue to the balance sheet. Balance sheet is a way that easy to grasp. Think of it as a snapshot of your business financial health at a specific point in time, like a photograph of its money situation a particular day. So the balance sheet shows a fundamental equation. Asset is equals liability plus equity. Think of it like this. Assets, what your business owns, like things that have a value and can benefit to the business in the future. So liabilities, what your business owes to others, obligation to pay someone else. Equity, the owner's stake in a business. It is the net worth of the business after subtracting what it owes from what it owns. So let's break down each components. So what I've said earlier, asset is what your business owns. Assets are categorized into a current asset, like things can be easily converted to cash within 1 year. And non-current assets, things that will can benefit the business for more than a year. So, number one, tangible and intangible assets. Tangible assets, these are physical things that you can touch, like property, plant, machinery, and equipment. So, intangible assets, these are non-physical things that still have value, like goodwill, the good reputation of your business, like patents and trademarks. Number two is inventories. These are the goods your business holds for like sale in its normal operations, like raw materials, finished product in a store, or work in a progress. Number three is the trade receivable or account receivable. This is the money you own to your business by customers who bought your goods or services on credit but haven't paid yet. So the balance sheet usually shows this amount after subtracting an estimate for bad debts, the money you don't expect to collect. So number four is the cash and cash equivalents. This includes the cash in your business has on hand and any short-term, highly liquid investment that can be easily converted into cash, like short-term bonds. So these are the components of the balance sheet. So number two is liabilities. Liabilities is what your business owes. It is also categorized into current liabilities and non-current liabilities. Current liabilities, it is the obligation that are expected to be paid within a year. So, a non-current liabilities, it is the obligation that are due in more than 1 year. So, number one is the trade and other payables or account payable. So, business owes to its suppliers and other creditors for goods and services like you purchase on credit. So, example is the bills from your vendors. So B, short-term borrowings. These are debts that need to be repaid within 1 year, such as bank overdrafts or short-term loans. So number three, long-term borrowings. These are debts that are due to be repaid over a period longer than 1 year, such as the principal portion of the long-term bank loans payable beyond the next year. Number four is the current tax payable. This is the amount of income tax in your business that owes and needs to be paid within the next year. So number three is equity or the owner's stake equity. It represents the owner's residual claim on the asset of the business after deducting liabilities. It's essentially the net worth of the companies from the other's perspective. Number one is the share capital or owner's equity or capital. This represents the amount of money the owners initially invested in the business. For corporation, this is the value of the shares issued to shareholders. So number two is retained earnings. This is the accumulated net profit or net loss of the business that has been kept within the companies and not distributed to the owners as dividends. It represents the earnings that have been retained for future use or reinvestment in the business. So, the balance sheet provides a valuable snapshot of a company's financial position, showing what is possessed and its obligation at a specific point in time. It is a help to assess the company's liquidity, so it is the ability to pay short-term debts, solvency, ability to pay long-term debts, and overall financial stability. So now, let's talk about the cash flow statement or the tracking the movement of the cash. Cash flow statement, or unlike the income statement, which is focuses on profit, and the balance sheet, which is snapshot at a point in time, the cash flow statement tracks the actual movement of cash in and out of your business over a specific period, like a month, quarter, or even a year. Think of it like your personal bank account. It shows all the deposit, cash coming in, and withdrawals, cash going out. So why it is important? A company can appear profitable on paper according to the income statement, but still not have enough cash on hand to pay its bills. This is because profit doesn't always equal cash. For example, you might make a sale but record it as a revenue, but if the customer hasn't paid you yet, you don't have the cash in hand. So the cash flow statement helps you understand the short-term sustainability of your businesses, and it's the ability to generate enough cash to meet its immediate obligations. The cash flow statement organizes cash inflows and outflows in the three main activities. Number one is the cash flow from operating activities. This shows the cash generated or used from your normal day-to-day business operations. So the cash inflows, the cash received from customer for sales, cash received from interest or dividends. Cash outflows, cash paid to the suppliers, cash paid to the employees, cash paid for the operating expense like rent or utilities. Number two is the cash flow from investing activities. This relates to the purchase and sale of the long-term assets, things that will be benefit the business for more than a year. Cash inflows, cash received from the selling equipment, property or investment. Cash outflows, cash paid to the buy equipment, property and investment. Number three, cash flow from financing activity. This involves how your business raises capital and repays it. Cash inflows, cash received from issuing stock if a corporation. Cash received from taking out loans. Cash outflows, cash paid to the repay loans, cash paid for dividends to shareholders. So the last one is the net increase or decrease in cash. This is the overall change in your cash balance during the period. It's calculated by adding the cash flows from the three activities above. A positive number means your cash increase. A negative number means it decrease. And that's all for my report. I hope you understand and have some learning about it. Thank you so much. Bye!